Morning, everyone. Thank you for joining us. We'll just wait a couple of seconds and allow some people to join that may be a little bit late. I hope you're well. So, welcome to today's Market Insights and the investment webinar that we run with Alex and Chris. Commiserations to any England fans after the result last night. The good news is, unlike football, markets aren't decided in one moment of brilliance or one mistake. So we'll be discussing today how the markets are affected by long-term trends. Today's session is about looking at cutting through what is going on in the world and how this is affecting the market's investment decisions and clients' portfolios. Together with Alex and Chris, we'll be looking at what clients should be doing and how they can position themselves going forward. One of the themes we'll be looking at is volatility and how that can breed opportunity in the market. And it's also important that you're in the correct funds that reflect your attitude to risk and your capacity for loss. As I mentioned today, we're fortunate to be joined by our usual panel of experts. We've got Alex Brandreth, Chief Investment Officer for Luna Investment Management. Alex is responsible for the overall coordination of the investment strategy at Luna and is named as one of the top 100 wealth managers in the UK. Alex did point out that thing I said top 20 is because it goes on alphabetical names Alex Brand. We also have Chris Isaac, Chartered Financial Advisor at Pareto, who sits on the Pareto Investment Committee. Chris specialises in advising individuals, owner managed businesses, and also works with our accountants. And he will offer an overview of the markets from an advisor perspective. Today, we'll be looking at the increases in mortgages and interest rates, the impact this may have on clients in the wider market, the potential for wage inflation and the implications on the economy, the knock-on effect of developments in the Strait of Hormuz and potential impact on the markets and inflation, and Keir Starmer's resignation and the initial impacts on markets and the economy, with Andy Burnham coming in on Monday by the looks of it. Before we start, just some housekeeping. To mitigate any background noise, please make sure that you're on mute. The presentation has been recorded and will be available through the usual channels. The presentation should last around about 40 to 50 minutes. There's a Q&A session at the end. Please feel free to ask any questions via the Q&A button at the bottom of your Zoom screen. We'll also be looking at an interactive poll that we would like to ask you to answer, and Alex will be setting that up. Have you put that on?
Can we do that now?
So Alex, go that now. So, looking back at the last quarter, what were the key market developments and what surprised you both the most, and how have they influenced the way that you look at investments for clients and also for the months ahead?
Do you like I go first? Yeah. Morning, everyone. Thanks for that, and thanks for mentioning the football. It's a good way to start the day. I think there's three things that really kicked off in the quarter, which were most noteworthy, and you kind of touched on it in the introduction there, Stuart, to be honest. But it was one, the resignation of the Prime Minister. That was always going to have an impact, and is going to have an impact over the coming months. The second is the ongoing crisis, geopolitical issues in the Middle East. It was positive that you saw a ceasefire for all of, 2 weeks, and then things have escalated again. But that's having a big impact, as we've seen, on commodity prices. It's going to have a big impact on inflation in the UK. So that was key. And the final one has been artificial intelligence. You've seen some very strong earnings data coming out from not just US, but global technology businesses. And their share prices skyrocketed in the quarter. So, Japan, for example, the Japanese stock market was up 33% during the second quarter. And that's because of, one, artificial intelligence, but there's other factors driving it as well. So they're the key ones for me, which happens in the second quarter.
And yourself, Chris?
Yeah, I think, a lot of it's echoed with what Alex has mentioned. I think clients seeing a lot of these headlines, it can be unnerving. I know the last webinar, it was April time, and we had the Iran war kick off, and we weren't quite at a ceasefire at that point, but we had seen some positive steps, and the markets had seem to look beyond that, and I think we spoke at the time that a lot of that was some positive, views on the AI side of things, that actually that earnings growth was going to potentially outweigh maybe some of what was going on geopolitically, and I think that's nearly played out over the last quarter. But obviously, it just shows how quickly things change. Had this webinar been, a week or two ago, we would probably be sat here not really talking much about the Iran war, because it seemed as if that was now in the rearview mirror, and just as quickly as it stopped, it seems to have been stoked up again. So I think it just, it's always an unnerving time when there's things like that going on, and I think we've mentioned multiple times, especially when the people making the decisions at the top end, i.e. Donald Trump and whatnot, are very volatile characters themselves, that people aren't necessarily acting rationally. So yeah, it certainly can be an unnerving time. But I think, if anything, what we've seen over the last quarter, multiple quarters, years, is that even when things like this are going on, the markets do focus on the longer run, and our companies, earnings going up, and I think that's again probably been what's outweighing things over the last quarter. I think often the things closer to home, i.e. Keir Starmer resigning and Andy Burnham coming in, or supposedly on Monday. Again, when it's UK politics, it feels probably a bigger issue than maybe it will end up being. But what tends to happen is you get lots of rumours, you get lots of headlines. I think it was only a couple of days ago that Burnham's coming for inheritance tax again, and that's where the uncertainty, I think, again for clients can be unnerving, and it's about trying to keep a bit of a level head in times like this, because if you try and second guess every headline, and we've seen it in the last couple of years, where every budget that comes, there's always rumours about what may happen, and it's about trying to make sure you are in the right place, but certainly not make any too drastic decisions that might be trying to second guess something that never even comes into fruition. So.
And I think that's important. One of the things that we stress with our clients' investments is making sure you keep to your long-term objectives, as opposed to reacting to short-term insecurities. And the markets have priced in. They're not pricing in what's happening today. They're looking at 6, 12 months down the line, aren't they?
Yeah. Markets always look ahead, and I suppose that one of the key messages we said at the beginning of the last webinar, which when markets were a bit more depressed, was just we have periods of volatility like this, and if you'd panicked and you'd sold during April, then you would have missed a very strong quarter for returns in portfolios as well. And I don't know what the next quarter is going to be like, but it's about thinking about what your goals are. If you're retiring in 20 years' time, you've got the time and patience to ride out this volatility and use that 20-year horizon as your goal.
So I think a lot of the volatility, Paul was saying, is coming from geopolitical. We've mentioned this in the last few webinars, probably for the last 5 or 6 webinars, that the risk is geopolitical, but the fundamentals, when we're looking around interest rates and inflation and global growth, how are you positioning portfolios with regards to balancing the risk and opportunities in these areas? And following on from that, what should our clients be thinking about when it comes to their own personal portfolios, Chris?
So I think the first thing to say is diversification. Japan was the best performing market last quarter. As I touched on, it probably won't be next quarter. So it's about making sure that you're well diversified across different stock markets to benefit. AI has been the trade of the last quarter. It might not be this quarter. It's actually, excuse me, healthcare and financial stocks are doing quite well the start of this quarter already, because they've lagged. So it's about having that exposure, making sure you're not wedded to just one style or one investment strategy. The second is not just everyone was talking about the equity markets because they up and down, like give them the heart monitor. But it's about diversification across asset classes as well. So you can still get very attractive returns from bonds at the moment with where interest rates are. We can buy structured products. We can buy other alternative asset classes. Gold's had a bad period more recently after having a stellar year last year. So it's about having exposure there. So when it does this, when the market do start to perform in those areas, you've got an exposure to it as well. So, and that's what we've always done. It's about making sure that you're well balanced within your approach.
Yeah, I think it ties in, and sometimes it's easy. And we've had over recent years and quarters where certain asset classes or certain assets themselves, gold, as you touched on, Alex, it's sometimes easy, and we see it with clients that, you know, the things that are doing well, and you know, with investments, they can have significant returns. We spoke about Japan, but, you know, gold, you know, you're more across the figures, Alex, but it's easy at times like that to, well, we need more gold, or should I just put all my money in gold? And we've had conversations over, you know, recent years. I know you'll have had the same, Stuart, where, well, why are we bothering with the UK and Europe, and why should we not just be in the US? Because that's for the last 15 years had provided all the returns. And it's about trying to stay level-headed when, you know, we're seeing it now with AI. It's easy to say, well, should we not just be all in on AI because it all stacks up? Everyone's going to be, you know, weighted hand and foot by robots, and, you know, and it's about trying to stay level-headed, I think, and not just chase what's done well. And you know, as you would know as a portfolio manager, Alex, it's about being spread across all of them, but not overweight to any of them, because it's easy to get caught up. But on the flip side, it's easy if things are, you know, commodities is a good one. Then, you know, post Russia Ukraine, prices came down again, oil prices, and it was easy to say, oh, well, we don't need commodities anymore because they're underperforming everything else in the portfolio. But often it's the times when things are underperforming the most that they then suddenly, you know, show their worth. So it's about not getting kind of too caught up on the upside, but also too negative on the downside, and making sure you are diversified, because, you know, that's what will hopefully keep you invested and keep a bit of a steadier path for you know, during times like this.
And you mentioned commodities. When we talk about the Straits of Hormuz, which we mentioned before, there's a blockade, and none of the ships that have passed through the Straits of Hormuz, excuse me, they've all arrived at their destination. So up until that gets released, there's still going to be a time lag, isn't it?
Yeah.
Coming on with commodities, with oil, with fertilizer, in the Northern Europe.
Yeah.
And that's going to affect inflation and potentially look at even further, perhaps wage inflation. And we don't want to get into that inflationary cycle.
No, I think we've seen it before, and it's all very recent in the memory, isn't it? Because of what happened when Russia invaded Ukraine. So just the oil price did spike up quite significantly. It fell back significantly, got down to about $70, and now more recently it's up 20% at 85 after what's happened over the last week or so. So you can see it already that's coming through. I was reading this morning that inflation in the UK is expected to get to about 3.5%. So you compare that to where we were in 2022 when it was double digits. It's more manageable. I think this is more acceptable, maybe, at that level of inflation. Bank of England won't like it though, because their target's 2%. So I probably would expect to see one interest rate hike in the summer months, or in the autumn, coming up, just to try and combat that, because they have to show that they're doing something. But that, again, if you go back to 2022, interest rates started at 0.1 and ended at 5.25. So you had a 5% increase in interest rates, and we're talking about a 0.25 this time. So there's certainly some inflation coming through. It's over interest rates, and then, like you say, it's the knock-on implications of what that actually means. So already mortgage rates have gone up, which means there'll be less buying activity. Loans, etc., will be more expensive to do now because bond yields have moved up on the back of this, and the expectation that interest rates are going up. Wage inflation is an interesting one, because at 4%, 3.5%, 4% inflation, employers might not want to be passing it on. They can probably get away with it. It's more difficult when it's at 10%, but, you know, average pay rises in the UK are probably in line with that level anyway. So you're not too far away. So that should be okay. And what we've actually seen over the last 6 to 12 months is unemployment starting to pick up quite significantly. Youth unemployment, and that's also to do with what the Labour government have done more recently. So that might actually keep a bit of a lid on wages, because when you see unemployment starting to creep up, there's more people out there looking for jobs, so it tends to be more competitive, and people don't ask for pay rises as much. So we'll see. And just one more point, I think, you know, what's the implications of AI longer term? I was speaking to someone the other day. I think we probably would have hired someone at Luna in the last 6 to 12 months if it wasn't for AI, but we're using it so much more now that it's making us more efficient, and we don't need that kind of graduate role at the moment. The problem with that is, though, what happens in 20 years' time when you want those people coming through to get the experience? It's not there. So you need to be thinking about that as well in the picture. So,
Yeah, I think it's interesting actually. I think it's easy to look back to 2022 and kind of assume that we're going through the same thing as we did back then. We've had, a start of a war, an oil price spike, but I think, and not to get too technical, but I saw some data over the last couple of days about US inflation, and it's kind of showing that actually when you do strip out the energy element of it, everything else actually isn't really going up too much. I think this time it is mainly energy that is causing the shock, whereas we go back to 2022 and as you mentioned last time, I think, Alex, inflation was going up well before that had kicked in. There was supply issues, and it ties in actually to the point you mentioned around the unemployment rate. At the time, there was what I suppose some would view as an opportunity that actually if you changed jobs, you were getting big wage increases, and there was post-COVID, it was we can't hire people and we can't retain people, and there was I think the power was in employees' court, that they knew that they could leave their job, go elsewhere, and probably get a pay rise. And I think I feel certainly at the moment with everything that's gone on since that, I think there's less opportunity out there at that point, and that as you mentioned, Alex, probably will keep a cap on potentially wage inflation, because there isn't that. I think people probably don't have or feel as much security about the job market in general, which means maybe they won't look for that better paid job or maybe ruffle feathers with their current employer. So it obviously.
And inflation isn't always a bad thing, is it? It's a good way to inflate way out of the debt, the £3 trillion that we've got ourselves into in terms of GDP. I know what you're saying about. I think the government might quite like inflation being slightly. I know the Bank of England will, but it allows us to inflate way out of the debt that we've incurred.
Yeah, and for companies, it's a positive as well. As if you can pass on this inflation in terms of higher prices, then you're going to do better. I mean, my favourite stat was the phone companies all increasing prices by RPI during 2022, and RPI always runs higher than CPI. So, excuse me. So it was a cheeky way for them to pass on higher prices. So you see it all the time, unfortunately.
And I think as well, you can, I suppose, get caught up from what might happen to inflation. What's going to happen to interest rates. But I think what we've certainly seen since 2022 is we're in a time where inflation is probably always going to keep bubbling back up, whether it's due to geopolitical issues, but we're not in the same low rate era as we were pre-2022, and historically the best way to defend against inflation is by investing your money. Sitting in cash, although headline rates are more attractive than they were a few years ago, over time inflation is eating away at that, and you look back, and especially over the longer term, 5, 10 plus years, the best way to hedge against inflation is by being invested in global equities. So I suppose you can worry about what may or may not happen with inflation and interest rates, but often it's, well, what can you control? Well, actually investing your money to maintain its real value or grow its value above inflation is one of the best things you can do. So actually it's about thinking about, well, yes, this may be a risk, but what's the best way to, hedge against that? And it's probably not sitting all your money in cash, because, you're not going to keep up with your bills over the longer run, but it's about obviously maintaining balance,
Sorry, Chris, I was just going to say, I was speaking to a client the other day, and they didn't realise that, when you quote GDP, it's include inflation. So you've got a US economy which is growing 2% this year, and then you've got 3% inflation. The US economy is growing by 5% this year. That's pretty significant.
Yeah.
UK probably grow at 1%. We have 3% inflation. UK is going to grow by 4% this year. Not bad.
I mean, I think people would pull that every day in the cash, wouldn't they? But in terms of markets, we're actually seeing markets outperform cash quite significantly. And you mentioned it before, Chris, as opposed to people sat there maybe having a little bit of an emergency, a little bit of a security blanket, having money in cash. But you can't have too much. So when we're looking at markets and the performance, some areas have outperformed, while others have lagged. Where do you currently see the most attractive opportunities, and where would you exercise a little bit of caution?
Finding opportunities everywhere. I think there's not really areas where it concerns me at the moment in terms of if the market's overpriced. Smaller companies probably look a little bit more attractive. They've been under the radar. I've always been focusing on the larger businesses in most markets, the US, Japan, and UK. So smaller companies have been left behind a little bit. And if you do have this positive economic backdrop, that tends to be a good period for smaller companies. So that's probably one area we're thinking about at the moment. Sorry, go on.
No, we mentioned before the webinar, you mentioned about 2 companies on AIM.
Yeah, we've been lucky that we've had 2 bids for 2 AIM companies. AIM's been out of favour because of the changes they made to business relief in the budget, which is now coming into effect, as it was been half the inheritance tax benefit that you got from buying AIM companies. But yes, we've had Advanced Medical Solutions, and today Gooch and Housego bid for. Gooch and Housego shares are up 40%. So again, and that's both have been bought by American private equity, which is coming over. So they're looking at the valuations of these businesses and thinking they're pretty attractive. So there's definitely some opportunities there within what we do. But yeah, it's a good day for AIM portfolios today.
Wonder why I had a smiley face.
Yeah, it's not to do with football, but there you go.
Yeah, I think it's interesting actually certainly for clients with maybe cash to invest. And Alex and I were on a call recently with a client where, you know, it's times like this can feel pretty nervous to certainly add money into the market, because you see the headlines, you see the volatility, and you see that despite all of that, markets are actually still near all-time highs. And I think that can sometimes be a bit of an uncomfortable mix for people, because they think, well, you know, we're at a high point, which surely must mean a low point is going to follow. But also, you know, I see that there's an AI bubble, and there's lots of things that if you read all the news, and you know, I can see why people wouldn't be comfortable adding money. But I think that's where, and I say it every quarter, it comes back to thinking about the longer term. And it's certainly not saying, you know, all of my surplus cash or even all of my cash needs to be invested for the long term. But it's about thinking, and I think thinking in time horizons is crucial. If you're not comfortable with maybe what it feels like at the moment, well, there's a few things you can do. You could not take as much risk with that money, as Alex touched on. There's value in bonds in the lower risk portion at the moment.
Yeah.
So you don't have to be in 100% global equities. And that means, you know, that in times like back in March, when, you know, the markets did fall, if you were in a more balanced approach, you would probably wouldn't have felt the full 10% fall that the market's about. It might have been closer to 4, 5, 6. So, you know, there's things you can do that will reduce that volatility, but, you know, you don't have to invest it all at the same risk profile as well. So it might be that sometimes, you know, you're bucketing it in your head and saying, well, you know, this is the money that I'm not going to touch for 10 plus years. So I can take more risk with it, but I know I'm going to need to spend. Well, let's keep some of that back. And I think, you know, I touched on the risk of inflation and kind of keeping your money in cash, but, you know, as long as it's not there for 10 years, it's not a bad time you don't have to rush in. You know, it might be that you have an end point and say, you know, ideally I want to have this amount invested in the next couple of years, but it doesn't all have to go in today. So it might be that you start a strategy and you're still getting a decent return on cash, or maybe, you know, short duration gilts, and it's then phased in over time. So it you know, what I like to say is it reduces your potential for regret. You know, if the market keeps going up over that year that you've spread it all in, would you regret it that you didn't put it all in day one? Maybe, but probably not, because everything's still gone up. If you put it all in on day one and it all falls, you're definitely going to regret that more. So sometimes it's, you know, maybe dipping your toes in and doing it in a more staged manner, and that can, you know, hopefully hedge some of your fears around where we are at the moment.
I was just sorry to jump in there. So we've got a variety of clients, obviously. Some that check their portfolio value every single day, others that don't check it ever. And it's quite interesting, the expectations of people that don't check their portfolio, because we've been to a few meetings recently, and it starts with, go on, tell us the bad news. And then you go in and say, well, you actually made 10% over the last 6 months or 12 months or whatever it is. And they're shocked, because if you just listen to the newspapers or read, you know, the news, then you'd expect things to be terrible. But in reality, the portfolio values have done very well, actually. I don't know if you have the same conversation.
Yeah, I mean, we go out with the clients, and the expectation of what we try to drive when we see our clients is 90% of most of the return comes from a well-diversified portfolio, and making sure that you've got the good funds within those different diversified areas. When you say in education, it's like just trying to explain that actually Warren Buffett try and swim against the tide. So when others are fearful, you be strong and greedy. And when people are being greedy, you be fearful. And it's taking that approach and the long-term objectives as opposed to short-term volatility. It's just interesting you mentioned before. One of the things we haven't touched on is the change in legislation. So we've seen 2 major changes in legislation. One is business relief, and how that affects both people's private companies, but also AIM shares and money that is held in those. And secondly, pensions coming into inheritance tax values from April 2027. So Chris, I don't know if you briefly just want to touch on, for clients out there that may have their own limited company, they may have some shares in AIM, for people who have got money in pensions. There are things that we can do proactively to mitigate tax, isn't there?
Yeah, absolutely. You know, I think, and you'll be the same, Stuart, that a lot of our conversations, you know, nowadays is often discussing around inheritance tax, and if anything, it's pushed it more to the forefront, because, you know, it used to be something that was only viewed as, you know, you're super mega wealthy and it's going to hit you. But you've got people now who, just because they've, you know, had a house for a while and it's grown in value, or they've built a business that previously was excluded, that suddenly, you know, you've gone from having potentially limited or very little inheritance tax liability to a significant sum. So, you know, we've been obviously discussing it, well, coming up to 2 years now, since October 24 and the changes, and we've had the business relief change come in the April just gone, and it's now thinking about, you know, strategies around whether it's gifting, it's trusts, it's whole of life cover, or different protection policies. It's ways of, you know, balancing your objectives and saying, well, you know, can I put things in place that will still mean that I can achieve my goals in terms of meeting my lifestyle and my income needs, but maybe helping out the next generation or two and reducing that inheritance tax. So we, you know, again, pensions, as you mentioned, that's the next one coming in, that from 2027, April next year, that your pension is now going to be included in that calculation. And again, there's some general housekeeping to be done, that I think, if, you know, we see clients sometimes that might have jumped around a few jobs, or, you know, set up the odd pension. And if you've now got, you know, 3, 4, 5 plus pensions, now is the time to be getting those organized, because, you know, we've been speaking with providers and HMRC about actually what that process will look like upon, you know, passing away. And, you know, trying to liaise with one pension provider sometimes is bad enough, especially these legacy ones, let alone 5, and getting them to all communicate and provide everything in a timely manner, because you've got 6 months from the date of death to pay that inheritance tax liability. So, you know, it's really often at the moment, you know, as you touched on, we're going into meetings, and initially it might be, go on, tell me the bad news. And actually often there's a bit of a pleasant surprise, because despite everything that's going on, and I touched on before that, you know, the world is a bit of a crazy place, but markets still find a way to trudge on. But actually then it often quickly moves away from investments and returns and things that we can control, and saying, well, you know, these changes are going to impact you. What can we be doing now to actually start impacting that? And sometimes, you know, those changes, and that might be starting to draw from your pension earlier and gift that away and things like that, you know, that will probably move the needle more than potential investment returns, because of, you know, the significant impact that will have.
And I think that's one of the benefits of working alongside you guys at Luna, that if you're getting the 7-10% returns for some of the clients' portfolios, if we're not doing our job, and potentially there's a 40% tax charge on that,
Absolutely.
all of a sudden the impact from 10 to 6% net return, an awful difference. So it's not only about the return, it's making sure that it's set up as tax efficiently as possible.
Absolutely.
Yeah, absolutely. You know, it's making use of all your allowances nowadays and making sure things are in the right place. And that, I think, even more crucially, then drawn from the right place at the time it comes to spending things, well, it's absolutely crucial. And, you know, I feel for clients a lot of the time, and obviously if you're advised, you know, you're in a better position because you've got people, you know, doing the work for you in terms of that. But nowadays, being a self-investor, or, you know, managing your own retirement strategy, there's so many potential trip-up points that, you know, because the rules have changed so frequently, that you can't just use a rule of thumb now. It really is that every client we sit down with, we tend to be doing different things for them in terms of where we might be drawing things from, because, you know, every client situation is different. So it's yeah, it's not an easy time to be managing things on your own, especially when you see the headlines, and then you've got to then worry about the tax and the planning alongside it. So yeah, I think, you know, it's now's no better time than ever to be chatting to your advisors, your investment managers, your accountants, your solicitors, and making sure that, you know, you've done everything you can control to put you in the best place, and then you let the markets do what the markets will do.
And one of the things that we always stress is having regular reviews, because circumstances change and its priorities, objectives change, legislation changes. So get in touch with your accountant and your solicitor. If you have a will, go back and review your will. If you've got a power of attorney, go back and review with all the legislatory changes that have come in.
Absolutely, yeah. And you want to be doing it at the time when there isn't pressure or stress or grief. The last thing you want is someone's health to decline, and then you realise that the will isn't how you would have wanted it, or there isn't a power of attorney in place and it's too late, or that you didn't take out the right level of protection and your health has changed. So there's no better time to do it than when you can do it. And, hopefully you look back and go, oh, well, I never needed that life cover, I never needed this, but it's the times when you haven't got your ducks in a row that often it comes back to bite you.
So just moving back to the markets, there are clients out there that we're seeing that are a little bit uncertain about the markets, and I think you touched on it before, Alex. What would be the key messages that you would say to any clients out there who maybe are a little bit apprehensive? What do you think are the most important actions for them to actually stay invested or focus on the long-term goals? What would you say to these people that are slightly more cautious and apprehensive about the markets?
I'd probably say try and veer into Alex's camp on this side of, don't try and check your portfolio every day, because sometimes you can't explain why it's going up and down. But I made a note of everything that's happened in the last 10 years, going back to Brexit. We've had Brexit, trade war 2018, COVID, Ukraine war, some bank issues with Credit Suisse in 2023, Liberation Day, tariffs last year, Iran this year,
Argentina.
Yeah, we won't go there. And if you looked at that and you had no clue of what's gone on in investment markets, and you compared it to other time periods, you'd go, well, surely it's been an awful time to be invested because of everything that's been going so well. And actually, it's been one of the best times. Global stock markets have averaged 10% a year in that period, and you might not have been able to hold on throughout all of that or been invested at that level. But even at balanced approaches, you've got really good returns. So I think my message, and I've said it before, is try to tune out some of the noise. You can only control so much. Take the necessary steps to do the things you can. And as you mentioned, for people that are a bit more cautious, well, you don't have to be invested in 100% global equities. You can keep more back in cash. You can dip your toes in. It's about being comfortable. But sometimes the best thing you can do is ignore a lot of the noise, because that otherwise you will end up making a rash decision. But also, I think, speaking to your advisor and picking up the phone, don't be afraid. We're here and we don't always know when people might feel uncomfortable. We try and be proactive and check in on clients and whatnot, but sometimes it might be something fairly obscure that suddenly makes someone a bit nervous. And actually, often picking up the phone to your advisor and saying, I'm a bit concerned about X, Y, Z, talking it through and making sure that you're still in the right place. And maybe there are changes that need to be made, but actually being open about that and speaking with advisors will hopefully mean that you can be proactive about it.
And Alex, from an investment manager's point of view, for people who are a bit nervous and cautious, what actions would you advise them that they should be thinking about and taking?
Our busiest time is whenever there's an event that happens. Chris touched on that are comfortable. Sometimes they're the best times to make investment decisions. Back to what you said about Warren Buffett, be greedy when others are fearful. So, I think that's key, really. I don't think I can add anything more. I think you touched on all the important points there.
So just looking ahead to the next quarter, we've been quite retrospective in what we've been discussing. What do you think are the biggest risks that investors should be looking at and monitoring? What indicators will you guys personally be looking at as closely as possible?
I mean, for me, we always look at PMI data, purchasing manager indices. They give you a good underlying feel of what's going on with the economy. So, for they don't know, their surveys at the WP, very better or worse, and that gives you a very good idea of what's going on with the economy. So that's always a really useful thing to keep an eye on. The second is inflation. Is it getting to 3.5? Is it going to get to 4, etc.? Keep an eye on that, because that's going to impact what the Bank of England do. That's going to impact your bond returns from your portfolio. Really important. You've got to keep an eye on geopolitical stuff. I mean, you can't get away from it, unfortunately. It's Donald Trump keeps being a job with the amount of developments that is ongoing. But we'll see what happens there. And then, artificial intelligence, as I said, I mean, what's driven the last quarter is probably more likely to drive the next quarter again, in terms of, is this global build out of artificial intelligence data centers and the chips that are required to do that going to carry on at the pace it has been? Because if it does, that means those earnings can continue to be strong for those businesses. And you're seeing shortages of chips at the moment because of the amount of demand that's going through, which at some point is going to start to impact mobile phone costs and things like that, because there's so much demand for things. So that's, again, could be a little bit of inflation that comes further down the line. Okay. Chris?
Yeah, I think focus on, really things you can control. I think the key, certainly from an advisor's point of view, is, potential needs for income or cash that maybe isn't already built into your plan. I think that's often the biggest thing that not derail a plan, but can kind of, if it's a bit short notice and it happens to be at a time when the markets are down, if we've been thinking about that or know that there's a cash flow need, whether it's buying a car, paying off a mortgage, whatever it may be, if we can plan for that, ahead of time, it means that, we can say, well, actually, we're not at a bad point at the moment. Let's take that out now, pop that in your, in your bank account, and know that that's covered. For us, it's about, ideally trying to have a plan in place for when you're going to need that cash. So certainly, thinking about the next quarter and onwards, from our point of view, you think about, is anything changing? Do we need any more income? Things like that we can then manage. And then, I would say, think about where you might fancy your next holiday or a nice meal out, because, live your life and let that worry about what's there.
Volatility can be reversed by on your wash bow.
So just going back to Ukraine, had the issues with Israel and the Palestine conflict, they will be all the individual opportunities for companies to be able to go out and make money. Yeah, like Donald Trump says he'll put a $20 million tariff for cargo schedule for the Strait of Hormuz. So opportunity, volatility, and opportunity is about, don't choose to save an investment. It's quite good. The most thing if you did, it's just smart thing, and you can take advantage of that.
Yeah, I mean, I don't even know more. And to be honest, going some contact that catches you from left field, there's probably global the better trail, low political matters going on. So, and then you've got if that person any deal which is either you for a good spare. So it's all and that impacts individual companies as well. So there's always a volatility, asset classes, stocks, and different regions.
So features pools of the whole and basic variables is just spent this around. In terms of the biggest concern in the market is the economy. 50% of people in UK those are taking industry changes. We're looking at second global economic slowdown, 13% potential AI market models, and 30% escalating conflict in the East.
It might be very really have we in terms of what happened in the quarter to the markets and things like that. So, I mean, I think as the quarter went on, its arms days were obviously set up on inside and the local elections and then all the landlords and issues. It just kind of took this whole nightmare for him, wasn't it? And there was a fear in the market originally because some of his comments we dealt with the bond market. Either the bond market were probably not the best. I wasn't feeling too optimistic myself as an investor, despite the fact that based in Manchester and an Everton fan as well. But
It'll be interesting to see the Chancellor.
yeah, well, that's the key mental stricken markets indeed. It's 2.5 years for the unemployment going up, the tax that we all pay nowadays, highest it's been outside for tax taken for a long time. So it will be interesting to see what happens. But he has rolled back. He's committed to the fiscal rules. It's a big tick for me. He's got some sensible people around him now in terms of advising, and he said that he will be looking at UK fiscal policy very closely, which is a bit of a relief. So I think the market actually, the bond market that is, was a little bit strong on the day when Keir Starmer resigned. And if anything, more recently it's been weaker just because of the issues in the Middle East. But we'll see. I think it's something that we all need to monitor, and you've already touched on the inheritance tax perspective as well. I mean,
I think sometimes as well, it's going back to headlines and everything is everything going on in Iran, as you touched on, was driving up bond yields anyway. suddenly it coincides with earner potentially coming in, and sometimes it's easy to just put 2 and 2 together and say, well, because of X, it must equal Y. But we're in a global world where it's not always what might be happening, and I think it ties back to often for clients naturally what's going on in UK politics or the UK economy feels like the biggest impact, and certainly on tax side of things it is. Certainly on investments, there's your UK exposure is often not fairly limited, but it's a global world investing. I think we've seen a lot of changes in the last 2 years, and I wouldn't be surprised to see more changes. Trying to second guess those is notoriously difficult. In the last couple of budgets, we've had lots of people wanting tax-free cash for pensions and things like that, and it's hard to know what may or may not be the best thing to do. So we always
Just still getting questions like that.
just questions and
Should I tip a tax-free cash?
yeah, and it's if there's a purpose for it, then potentially yes. But obviously, it always comes back to every client is different. You can't say, well, because of Andy Burning coming in, you should do X, because everyone's got different situations. So I think it's about trying to remain calm where possible. I think what the UK has been struggling. It's the leader may or may not have an impact. I think from the sound of it, but there might be some more drastic changes coming. But that doesn't always mean it's bad. There's talk of land value tax and things like that, and it's funny often how whatever the headline is, stamp duty is often derided as one of the worst taxes possible because it stops people moving. But then as funny enough, if someone suggests, well, let's try something different. Oh, but that won't work because of X, Y, Z. And funny enough, there'll always be someone saying that something doesn't work or won't work, and that's always.
And also ways around it. I think your window tax breaks up the window. See it London and
So I think there's going to be a lot of noise over the. Well, I think we're already seeing it, but there's certainly going to. I imagine coming up to the next budget, there's going to be noise. So I think it's about trying to remain calm and not panic.
Well, I think one of the answers here that surprised me is what is the biggest current concern for the people in the webinar? Not one person has said rising energy costs and inflation.
Okay.
And it's all over the BBC news at the moment about energy prices going up, but obviously for our listeners out there, that doesn't appear to be a concern for them.
That's the next one.
Second question, how optimistic are you about global markets over the next 12 months? No, none of our listeners are very optimistic. 63% neutral, 13% somewhat optimistic, 25% somewhat pessimistic. So
I think
that bell curve right in the middle
seems to tie in with my message of try not to get too excited and not get too scared. So everyone's must be listening.
And then the third question, what impact do you expect from the disruption in the Strait of Hormuz? You briefly touched on major global economic impact, 25% of our listeners, 38% noticeable but manageable impact, and then 38% limited short-term impact. So I think once it gets freed up, we've got around 6 to 8 weeks of getting back to some form of normality as we can with the Panama Canal crisis, and we should start to see the markets react positively to it.
Yeah, that's what I mean. That's how long it takes to get these tankers through, but I don't know. I think this could run along for a while. You could see ceasefires on and off, as we already have, but who knows? Like Chris says, you're dealing with egotistical individuals on both sides, and they both want to be right and they both don't want to lose. So it's a difficult situation.
Fourth question, how optimistic are you about your own financial situation? 13% very optimistic, 38% somewhat optimistic, 38% neutral, 13% somewhat pessimistic, and not very pessimistic too. I mean, that's conservative, cautious approach out there that we advocate.
I think as well, you have to try and be optimistic. At the end of the day, if you're too pessimistic, you'll end up not making a decision. You'll end up not investing. You'll end up, if you always think the worst is going to happen, you're not going to end up probably in a good position in the long run. So I think sometimes you have to try and be optimistic, and people find a way, businesses find a way, and people are resilient, and it's about trusting that people will continue to find a way, and things will get better.
I think that's a really good point. Our clients, business owners, are entrepreneurs, so they do find a way to cope with changes that happen both legislatively and also in terms of the fundamentals in the market.
Yeah, I think that's the one positive that you've seen over the last few years. The amount of things that have been thrown at individuals and companies and the ability to adapt. And right now you've got countries adapting to how to get oil out of there. If you want to go through the Strait of Hormuz, how do you get onto the other side to get it out? And there's pipelines being built. So there's ways around these things to get resolutions done.
Okay, good. So just with regards to questions and answers. So we've got one question that's come in.
About the
Has
sound.
everyone experienced some muffled sounds? Excuse me for that. Apologies if the sound quality hasn't been great. So a key takeaway from today's discussion is that successful investing in the environment is less about making bold single direction calls and more about building resilience, balancing risk, maintaining flexibility, and making sure we're looking at the other factors that are going around in terms of the geopolitical sphere, but also the larger macro and microeconomic situations that we're in. I'd like to thank our panel for their valuable insights and, of course, Lena for helping guide today's discussion. Thank you all for joining us and contributing to our poll. I hope you leave today with a clearer sense of not only knowing where markets may be heading, but also how to think about navigating and working with ourselves to try and take advantage of these markets. So, Alex, Chris, thank you for your time. We look forward to welcome you to the next Pareto Market Insight session, and that will be in about October time. Thank you for answering.